Good morning. This is Ken Long at Tortoise Capital with follow-up webinar number 3 for the Advanced Swing Systems Workshop. And this is a collection of some of the lessons we didn't get a chance to get to during the resident portion, and which will complete our discussions of our swing trading approach. So just some topics to highlight. Just remember that in our view, and based on evidence and scholarship, that about 50% of a symbol's performance can be attributed to the market, 25% can be attributed to the sector that it's in, and then 25% can be attributed to the stock itself. If you're trading sector ETFs, you can work away that 25% of variability of the stocks and concentrate just on getting the market right and then the sector right compared to its peers. And so that will simplify your targeting and universe selection. And then you can be looking at, in general, the performance of your stock against the sector and against the market. So if you have a stock that is strong, but the sector is weak and the market's going down, then what you have is evidence of a stock that is really being bought for its own purposes. And when the sector and the market turn, we wouldn't be surprised if that stock was going to continue to be a superstar. So now when everything is going in its own direction, this should be an awesome performer until it's fully valued. Similarly, if the market is indifferent, but the sector's down, but the stock is up, then you have clearly a leader inside of a sector, and all other things being equal, you would want to favor the relative strength of that stock. Knowing, however, that if the market does turn, or if the sector gets worse, that's going to act as a drag on the performance that you can get. And so anytime I see a divergence between a market going down and a sector going up, then I narrow my focus on the long side to just those things, because clearly this is the kind of sector and presumably the kind of component, the component pieces of it, that do well when the market's doing poorly. Maybe that's treasuries or some other form of hedging. So in my view, if you take a top-down approach and use your analysis of market, sector, and stocks, you can stack up more odds in your favor by just adding a little bit of analysis here. So if you're going to spend time to search through dozens or hundreds of stocks, spend the extra time to look through a dozen sectors and the market itself in order to get a more complete picture of the volatility dynamics. Now, if you have a strategy for classifying markets, and I covered that in our workshop, in this case, my market classification, market condition assessment tells me that when I'm in any kind of bull market, volatile, normal, or quiet, and a sideways quiet, that I have a reason to believe that tomorrow on average is up, and therefore I am inclined to hold positions overnight unless I have a reason not to. On the other side, though, bear conditions of any type lead to negative expectations for tomorrow. So if I'm long, I certainly want to have a very good reason to be holding it overnight, or unless I have a swing trade to the downside. And then in the sideways volatile and sideways normal conditions, then I don't have any added advantage to hold overnight, and I would be more inclined to take intraday profits. So if you develop a market condition strategy, or use mine, for example, you should know what that means in terms of the time frame that you're intending to hold. We have spent time talking our way through trading systems, and we know that most people like to look at the entry signal, but these other pieces of each individual trading system are at least as important, if not more important, than the entry signal itself. And remember that trading system is just one strategy, one system to be used in a broader set of strategies that are designed to give you an advantage in the market, and that your overall meta trading system or your trading business should include these additional areas to make sure that you are protecting your trading strategy and the individual systems inside a sound, robust business wrapper that's designed to protect you against the worst day in the market. Monthly review, I think, is a good time for swing traders to step back and ask a little deeper, more thoughtful questions than just looking at the particular results that you have, but starting with the results and the metrics and looking for patterns. Have I kept to my exercise and meditation schedules? Is there a relationship between how I feel and how I trade? You should know that. Were you adaptive in your position sizing, or were you bullheaded and staying with positions that were too large or too small, even when the market conditions changed? What were the biggest challenges? What are you most proud of? What do you regret? What can I carry forward into the new month? What did I learn this month? And so these sets of questions give you some of the more systemic and systematic, holistic views of your trading as a sustainable enterprise, and should be included in your monthly routine. To go back to the market condition a little bit, this is how I would suggest you analyze your different systems, particularly those that are mechanically traded, and see how they perform in these different market conditions. And so I know, mechanically speaking, that these three systems are the ones that are worthwhile trading on a swing basis in a sideways market, but some of these other ones do not. Like a triple screen requires more follow-through, persistent follow-through, which you see in a bull and a bear than you get in sideways. And so the trends don't last long enough, in my view, for a triple screen to really be as effective as some of these shorter-term swing systems. So this is a way that you can tune your market condition parameters to your swing systems, and perhaps use that as an additional filter or to inform your position sizing choices. Bottom line, your beliefs about self and systems and markets really are those core beliefs that protect you against stormy weather, and that what you're creating is really a financial program of real estate businesses and equities that give you protection against all of these generators of stress coming from many different sources. So your business plan, of which your trading plan is just one piece, anchored in who you are and what your purpose is in life, is designed to protect you against the worst days, not the best days. When you're using my reports, just remember that when I color code, it's on the basis of descriptive statistics. When I look at a important or relevant look-back periods, and I divide today's behavior in comparison to the previous behavior in terms of, I find the average, and then 1/3 of the data is found in white and in yellow, and 1/6 in green and red, approximately. And so this is average up to +1 standard deviation, and then beyond 1 standard deviation is exceptional performance, and this is below average performance, between average and -1 SD. And then if it's more than 1 SD beyond average, then it gets a red condition. So you can see in this example here, I'm looking at standard deviation divided by price to get a measure of volatility, and then over the last 180 days for SPY, that's what that time series looked like. And so most of the data, 2/3 of it, can be found in white and yellow, and only a small percentage out here in the green and the red, 1/6 and 1/6. And you can see what an extraordinary amount of volatility this was. And when it peaked, when it went beyond 2 SDs and reversed back, you had the end of that catastrophic sell-off, and then a resumption of some gains. So when you see my reports, I'm using descriptive statistics in that sense to capture general behavior patterns in the market. I typically think of where I am buying inside the life cycle of the expected move by using the idea of the mice and the innovators and the early adopters, the early mass adopters, the late mass adopters, and then the grumpy old men as the phases in which people get on board trends. So these are the young, bold mountain climbers, and this is the second mouse. And so perhaps the sell-off is what triggered someone to buy the statistic. That's bold. The second mouse waits for a tentative turning point and then waits for enough information to see that perhaps the original long strong trend is resuming, and so now a reasonable move is a retest of the previous swing high, or even a 50% retracement. And if I can frame my trades inside here using the swing low as my risk level, with the idea being that if this trade fails, that I'm likely to see another move as large as this move, then I can use this framework to ensure that I'm the second mouse. And so when I'm considering new systems, I try to answer the question, how can I structure these parameters in the system and these indicators so that I can be the second mouse, so that if larger money comes in to support this move that I'm participating in, it will carry me further up that slope on the backs of big money momentum, and then I can play my exit strategy when I see it slowing down and only the grumpy old men are left to buy it. So that's a general proposition about how I think about where in the life cycle of the move can I buy, and why I tend to be a bottom feeder looking for value, because risk has already been baked in because of a sell-off. Similar to that, the idea of the green and yellow zone trading, where I believe in terms of price that if I look at the previous price action, there is some area in which price has not voted whether it's going to have momentum going this way positively or going negatively this way. So when I'm inside either yesterday's or this week's or the 10-day or 30-day high and low, I think of myself as being in the yellow zone. And while I certainly want to buy when it crosses the green line so that I can be long when I'm in the green, I may be able, if I'm in near the bottom of the yellow zone, to frame a favorable trade just to get up and test the critical state. This is, you'll see in the washout and the 5DD pattern, a lot of those. So if this is the 10-day high, then if I can frame a 2-to-1 trade that gets to the 10-day high and then it breaks through, then the green zone is starting and I expect some new breakout money coming in, and then I'm free and clear. And so I use, in general, this idea of green, yellow, and red zone to characterize where in the life cycle and the context of the trade that I can be found. This says the same thing. I will leave that to you to review, but that's a description of the green zone, and really the same thing, the red zone, but with reverse symmetry. And then the yellow zone, where I'm looking to trade strictly inside the yellow zone, where I'm looking for 2-to-1 trade frames between what I would describe as the red and the yellow, or red and the green lines. The yellow zone is how I think about trading inside that indecision zone, or trading within the noise. And so I can set up my trade frames. I might be looking at various statistics, and maybe a swing pattern gets me inside of here, and perhaps I get an opening down in here, and then I can set my the green zone here, the start of the green zone, as my price target, and then I might set my my stop here, so that if I can get a favorable move in this direction, and I can get to the green zone, then I will have an additional entry. So I would be long 2 if it breaks through here. If not, I framed a 2-to-1 trade, and I can cash this happily. And similarly, if this thing starts to fail, then I'm ready to get long at the place where this trade is invalidated. So in many ways, one of my favorite patterns is a sell-off that terminates in a white candle, has a low open, but maintains support and starts to move out, because now I have a 2-to-1 to my intermediate or first target, with the promise of a much bigger move going beyond. But then if it fails, then it's easy to believe in whatever the size of the move was on the downside. Perhaps it was this kind of a move that got us into that from the 10-day high. If that's the kind of move, then if that fails, if that move fails, then I expect a move of that magnitude to the downside. So I try to frame that trade in both directions. Just a quick summary of what we know about momentum studies long term on monthly moves. That we know that 30-day momentum tends to be inversely correlated. That a very strong month of performance predicts an underperforming 1 month. And on the long term, the 3 to 5 year time frame, that's also inversely correlated. That a strong 3-year or 4-year or 5-year of outperformance in a region predicts an underperformance over the next same look back over the next look forward period, 3, 4, and 5. It's this spot here in the middle on the intermediate term between 3 and 12 months where data shows that a 3 months of outperformance predicts an additional 3 months of outperformance. And so one of the reasons to look at 3-month relative strength is that something that's outperforming on a 3-year basis, this outperformance could go from 12 months and beyond, but it started with a 3-month period in which it outperformed. And so if you can get tied into that and get dragged along through continued outperformance, you can actually turn swing trades based on momentum into longer term position trades. When I think of growing the trades, I think of my mechanical systems as systems B, in which I'm taking structured reward to risk ventures, and some of them, some percentage of them, last beyond 2 to 10 days because of that momentum factor I just described, and then it may end up becoming something that is outstanding on the monthly rebalancing as a sector. And so I can actually front run a trade that becomes hooked into the longer term monthly relative strength. So there is a relationship, in my view, once you get past about 10 days and it's still outperforming, that it just might be something that could grow into a larger monthly type of a position. Finally, the last thing I want to talk about is a way to analyze your systems. If you have stable rule sets and large data sets, you can do what I call trade index analysis. And in this case, I'm thinking back to a systems seminar I attended with Chuck LeBeau and Van in 1996, so we're on 20-year anniversary of that one. Well, this has really helped me a lot over the last 20 years, let me tell you. And so we consider the time that we're in the trade as T, and then, according to Chuck, you find the best price that was available in the 2T time frame. So if you were in the trade for a week, look out 2 weeks and then find the best possible price that you could have gotten out at if you had perfect information, and then take your exit and divide it by the best possible exit, and that will produce a number between 0 and 1. It's a percentage, essentially, of the optimal trade or the perfect trade. And Chuck said, if you can get 0.5, you're doing awesome, and you can make a living as a professional if you're getting 0.3 of the potential move. My refinement to this was to consider the time value of money, and I implemented this in a spreadsheet with XLQ in the following way. So my procedure would be to calculate the length of your trade in time T. So from the entry to the actual exit, this is time T. And then go out to the 2T time frame and find the best possible exit. Maybe that was the highest high in the 2T time frame. And so the best possible gain is B, and my actual gain was G. So G divided by B would be my index, my actual divided by the best possible, and that would be the efficiency index. Now notice you can only do this if you are examining wins, which is fine. You have to do a separate calculation for comparing the efficiency of losing trades, and by doing that you would determine how much potential losses are my stop losses actually protecting me against. Is it really protecting me against disaster, or am I realizing most of the pain that was available, in which case the stop is not as helpful? The other thing is this does not consider the time value of money, in which the best possible exit, if it happened in the T time frame routinely, then I'm staying too long. If it's happening routinely in the 2T time frame, then I'm not staying long enough. And so I can take the statistics of where the best possible exit is locating to help me understand the time value of money. And this explores the same idea, that if the best possible exit here was right after the entry, then I could actually have taken the shorter trade, and then you put that money back to use to come up with other trades, and I have to consider when I'm exiting as a potential opportunity cost, depending on how long I'm waiting for this trade to improve, and it never does. So in this case, this exit would be better than that exit because I have more opportunities in a positive expectancy system. So let's take this as a thought experiment, and that is, if the market is a complex adaptive system, our rule sets simply tell us when to stop stalking and when to enter when the market shows us certain conditions, and gives us rules for when to be in the trade until we exit, at which point we start stalking again. And so if our rule sets are well timed to the market's ebbs and flows, then our efficiency in harvesting the gains that are available between those two time frames should be good. So we can use this idea of trade index analysis to actually compute that relative efficiency for large data sets. So what I'm going to do then is, for each trade, calculate the time in the trade as time t, go out to 2t, add another t on there, find the highest high during the trade in the 2t time frame, and then also find the lowest low. And then if I've set some kind of 1R stop loss, I can determine how well that 1R stop loss protected me against the size of the potential disaster that was waiting for me. Then I can take my actual trade, and that is going to be my trade index, because I'm going to set the lowest low equal to 0 and the highest high equal to 100. I'm going to perform a little bit of and break this into 100 equal steps, and then however many of those 100 steps are in the trade from the entry to the exit, that's the value of my trade. I can then also evaluate where on the scale between 0 and 100 my entry was, and I can determine where inside that cycle of prices I am typically entering and then typically exiting, and then how much of the available move am I actually capturing. I can use the location before and after the T time frame to determine if those highs and lows are occurring earlier or later in my trades. So here we go. What I was interested in finding out. So what I was interested in finding out then was where my entries tended to be. And so if I saw something like this, where my entries were in way at the top, and I was getting this measured move between my entry and the exit, and my 1R was protecting me, I might very well have a positive expectancy system. But if I saw an array like this, then what this is telling me is that those failing trades have a tremendous opportunity on the downside, or the reversal trade. Or if it never even fires but continues to break down without even giving me an entry, then this might be a tremendous opportunity. And even after the exit, I should be considering how to frame a trade that gets me down in here to take advantage of where the largest unexploited moves are being found. So when I applied this to my mechanically traded data set of washouts and 5DDs, what I discovered was that my washout patterns were doing pretty well and getting me in around 44 and out at 70 on the index scale, and that the 5DDs were giving me this narrow range between 48 and 54. And here's what I discovered, was that the washout pattern, the one that I was most concerned about, was getting a good 26% of the possible range that was available on average, which was pretty good, I thought. And what this also told me, though, was that there was another trade near the top of a continuation, which was larger than the trade I was taking, because it's 26 points from my entry to my typical exit, and then 30 index points to the highest high. And so there was another trade of the same magnitude or larger in the same direction that I was not getting. And there was a trade from 70 to 0 on the other side, that the biggest reward was to the downside and not even to the upside. Even if I looked at from 44 to 100, I'm actually in the correct direction. There's 56 index points above, but somewhere in this line, that the failures were as equally interesting. And then even after a successful trade, like if that was a dead cat bounce and I got it, and then it started to fail, even if I waited to wait for the original entry to fail, to go below my initial entry, there was still a larger trade available that I was harvesting on the way up on a positive expectancy system with a system quality number better than 4. The 5DD, it was even more striking that I was making a reasonable returns on expectunity basis on simply 6 index points, and that 46 points were available to the upside and 54 to the downside. And what this taught me was that it's hard to come up with a positive expectancy system, but it's even harder to look at that and determine what are you missing when you're doing pretty good with it. So what I learned was I needed to develop a continuation pattern such that after successful trades in which there was reasons to believe that the momentum was there, that I could look for continuation patterns to continue to trade in the direction of the first primary trade, not just to trade them, exit them, and then forget them, but I should extend that narrative to look for more continuation patterns. And so I developed a common, I would call it a module, a common subsystem or component called the continuation pattern, which allowed me to relax some of the initial criteria and then participate in a resumption of the trend in the same direction. At the same time, this taught me to look very carefully at the failure signals when a stop was hit, or maybe the initial entry never even fired and just kept going in the same direction, that I had to be strongly considering the failure patterns as a way. And then by adding those two components to my arsenal, I was very much able to expand the power of all of the mechanical trade frames, and it taught me how to advance into structured trade framing that goes beyond just the simple mechanical pattern analysis, but actually allows me to trade to set up trade frames on the basis of reward and risk in the 2T time period. And so this trade index analysis is one of the best ideas I've had in 20 years that allowed me to extract more gold out of the mine that was being identified by these mechanical systems, which gave me good starting points, but through further analysis and refinement of technique, and then relaxing some of the criteria into strategies rather than mechanical systems, I was able to develop skills in trade framing that have served me very well over the last 20 years. So that's everything I want to cover on this third follow-up for the swing trades. Some additional ideas to fill in some of the gaps, and I look forward to continue to work with you and help you develop your systems, and to help maybe these systems fit your objectives. So thanks for your kind attention, and take good care.